Sure, I'm here again with Andrew Leavitt, and we were just talking amongst ourselves, and we just really thought that you guys would want to know this too. We were talking about all the FHA changes, and I was asking him what he thought about Trump reversing the FHA insurance reduction, and he was giving me a little bit of insight into how it actually is maybe not so much of a benefit to have had that reduction to start with.
Yeah, so FHA initially had what's called a 0.85 monthly premium on the mortgage insurance, and so that's the rating that you have to pay on a monthly basis. Now, the proposed change was to lower it to 0.60, so it's not a big change. The average consumer is going to see about a $30 to $50 payment swing if it were to got lowered. However, it ended up getting suspended and it did not get rolled out. And realistically, right now with FHA, they are not reporting as much earnings as, say, Fannie Mae or Freddie Mac. Those are your conventional outlets for loans. And so with them keeping this money, it's going to help them as far as generate more revenue to ensure that they can stay around for the next 5 to 10 years. So it's good. Not going to require government bailout or anything like that.
So just go over that one more time. Why is it important for them to have that a little bit of extra money withholding?
The last thing that you want to have is a big entity like that struggling for money. VA, FHA, they all have their own accounts essentially. But when you lower that money, and in the event that they were to go bankrupt, either it's going to require a government bailout or FHA could possibly go away altogether. Now, it's never happened, so most likely wouldn't. Most likely would result in a bailout, but nonetheless, it's something taxpayers don't have to worry about later.
Okay, so it's something that's actually really important that they do have the funds that they need. So we do have FHA loan programs available for people to get into a house at a lower down payment. Otherwise, you're 5% conventional, 10%, 20%,
right,
and so on.
Right. Yep.
Very interesting.
At the end of the day, if you were going to buy a house at today's market, again, your payment's not going to really change more than $30 to $50 on average in most cases.
And then what about, I know that they were talking about potentially allowing that mortgage insurance to drop off after a 20% equity in the property. Is that something we can maybe expect down the road?
At the moment, there's really no hard facts right now that are going to stipulate one direction or the other. FHA used to be like that, but again, they were suffering a lot of losses, and so they're really trying to generate some revenue right now to keep that stability going. We could possibly see it. They're saying the economy's improved quite a bit, but nonetheless, there's nothing really concrete yet to say that definitively one way or the other.
See, I think that would be more valuable down the road, is to be able to have your mortgage insurance fall off eventually. So maybe if they were to reduce it from the 0.85 to 0.6,
right,
they'd have less money coming in, and then that would never happen,
right,
because they would never have the funds to be able to do that.
Right. The biggest thing that a lot of people are looking at, and especially if you bought in your house in 2011 all the way up even to midway 2016, if you have that mortgage insurance, you can still look at doing a refinance. The best way and fastest way to get rid of that mortgage insurance is doing conventional refinance and getting an appraisal that shows that you're at that 20% equity position to where MI is not required or mortgage insurance is not required.
And so how exactly does that work? So that as long as they had 20% equity, they wouldn't have to come in with any additional money as far as a down payment. They would just pay the closing costs on the refi.
Correct. So essentially you pay your closing costs, which in most cases, if you got your house recently, the closing costs would be moderately low. And then they would have to do the appraisal. As long as the appraisal comes in at 20%, then they would be able to remove the mortgage insurance. One of the common setbacks that people look at is sometimes the rate may increase. If you got your rate back in 2012, 13, or 14, it's going to be probably lower than current rates. Nonetheless, if you look at the math, you just got to calculate your break-even point. How much is my payment going down? What is my new rate going to be? What's the real benefit here for me here? And so that's one of the things that we'll do is we'll run the numbers. And on more occasions, I tell people not to refinance because the numbers don't make sense. But nonetheless, it's always good to have a look and get a professional opinion.
You're one of those honest guys.
Yeah, the business comes back down the road. It may not be now, but usually down the road it comes back one way or the other.
Absolutely. Definitely. And so if, let's say somebody was, they were sure that they had 20% equity, they know that they're paying mortgage insurance, they know that they're, with the combination of the equity that they had in the property, with knocking off that mortgage insurance would lower their payment to where it would be worth it for them. What if they're a little bit of cash shy? Is that something that they could actually finance into the refi, or do they have to actually physically pay cash up front to do the refi?
The only thing you have to pay up front is going to be the appraisal. Appraisal runs between $495 and $550. If you have more of an exotic property, that's going to be the price range over $450. Appraisal fees may vary then. But nonetheless, you can always finance the cost inside the refi, assuming we won't exceed that 20% equity position.
Beautiful. Awesome. Well, thank you so much.
Of course.